Welcome to Keystone Property Advisors. Today, we're tackling one of the most debated questions in real estate: cash flow versus appreciation. Which one truly matters more for building wealth? If you're thinking about buying your first home, investing in rental properties, or simply trying to navigate the housing market, chances are you've heard these terms thrown around. But what if focusing too much on one and completely neglecting the other is actually holding you back from making smart, profitable property decisions? What if the conventional wisdom is missing a crucial piece of the puzzle? The truth is, most people entering the real estate market, whether they're first-time home buyers, aspiring investors, or even seasoned landlords looking to expand, often misunderstand the fundamental relationship between cash flow and appreciation. This misunderstanding leads to significant financial mistakes. Consider the first-time homebuyer who buys in a rapidly appreciating market, blinded by the potential for quick equity growth, without fully comprehending the true cost of ownership and ongoing expenses. They might find themselves house-rich but cash-poor, struggling with monthly payments, or unable to save for emergency. Or think about the new investor who solely chases high cash flow, buying properties in declining areas where rental yields look attractive on paper, but future property values are stagnant or even falling. They might generate some immediate income, but their overall net worth isn't growing, and they could face significant challenges if they ever need to sell. The hidden problem here is not that one is inherently better than the other, but that focusing exclusively on one without a deep understanding of the other's role and how they interact is a recipe for suboptimal returns and financial stress. Many overlook how these two forces, when properly balanced and strategically applied, contribute to a resilient and profitable real estate portfolio. Experienced investors and smart home buyers understand that cash flow and appreciation are two sides of the same coin, each crucial for different aspects of wealth building. Cash flow is the immediate income your property generates after all expenses: mortgage, taxes, insurance, maintenance, vacancies. It's the lifeblood that keeps your investment healthy and provides financial stability. Appreciation, on the other hand, is the increase in your property's market value over time. It's the long-term capital growth that builds substantial equity and contributes to your net worth. The mistake many people make is approaching this as an either-or choice. They chase the dream of rapid appreciation, hoping to get rich quick through market booms, often ignoring the risks of negative cash flow or unsustainable debt. Conversely, some focus so heavily on positive cash flow that they neglect properties with strong long-term growth potential, thereby limiting their overall wealth accumulation. The underlying principle that experienced investors grasp is that the ideal balance between cash flow and appreciation isn't universal. It's deeply personal and market dependent. It aligns with your specific financial goals, risk tolerance, and investment horizon. At Keystone Property Advisors, we advocate for a strategic balance framework to help you navigate this decision. This framework guides you to make property choices that align with your overarching financial objective. Here's how it works in 3 steps. Step 1. Define your financial goal. Are you seeking immediate income to replace a salary, supplement your current earnings, or fund your lifestyle? Then you'll likely prioritize strong, consistent cash flow. Are you younger, with a longer investment horizon, and primarily focused on building significant net worth for future retirement or large purchases? Then appreciation might take a more prominent role, potentially accepting lower initial cash flow or even breaking even, provided the appreciation indicators are robust. Step 2. Analyze the market context. Every market has different characteristics. Some are cash flow markets, characterized by stable property values, reasonable purchase prices relative to rents, and consistent tenant demand. Others are appreciation markets, which might have higher purchase prices relative to rents, but strong economic drivers like job growth, population increases, and infrastructure development, leading to faster property value growth. Understanding your local or target market is paramount. Step 3. Assess property metrics against your goals. Once your goals are clear and your market is analyzed, evaluate specific properties. Calculate the true net cash flow, considering all potential expenses and vacancies. Simultaneously, research historical appreciation trends for similar properties in that area, and critically evaluate future growth indicators. Don't just look at the asking price or the advertised rent. Dig into the numbers that reveal the true cash flow potential and a realistic long-term appreciation outlook. Let's illustrate this with a realistic example. Meet Sarah, a 55-year-old approaching retirement. Her primary goal is to generate $2,000 per month in passive income to supplement her pension. She doesn't need rapid equity growth. She needs reliable, consistent income. Using our framework, Sarah would focus on cash flow markets. She might target a duplex in a stable, blue-collar neighborhood where property values aren't skyrocketing, but tenant demand is steady, and rents reliably cover expenses and provide a strong net income. Her metrics would heavily favor a higher cash-on-cash return, even if the annual appreciation is a modest 2-3%. Now, consider Mark, a 30-year-old software engineer. He has a stable, high-paying job, and his primary goal is to build significant wealth over the next 20-30 years. He can comfortably afford a slightly higher mortgage payment and is less concerned with immediate cash flow. Mark would look for properties in appreciation markets. He might invest in a single-family home in an emerging tech hub, where property prices are growing at 7-10% annually due to strong job growth and limited housing supply. His property might only break even on cash flow each month after expenses, but the rapid equity growth provides a powerful return on investment over the long haul. In both cases, Sarah and Mark are making smart, strategic decisions because they've aligned their property choices with their specific financial goals and the prevailing market conditions. Ultimately, the synergy of cash flow and appreciation is what truly builds lasting wealth through real estate. Cash flow provides the crucial holding power, allowing you to weather market downturns, cover unexpected expenses, and even fund future investments without having to sell. It protects your downside. Appreciation, on the other hand, builds your equity, which can be leveraged for further acquisitions, creating a snowball effect in your portfolio. Over time, that compounding appreciation, combined with consistent cash flow, transforms your initial investment into significant financial stability and freedom. You're not just building a property portfolio, you're building a secure financial future. So what matters more, cash flow or appreciation? The definitive answer is, your goals matter more. There's no one-size-fits-all answer. Both are indispensable components of a robust real estate strategy. The key is to understand your personal financial objectives, thoroughly analyze your target market, and then strategically choose properties that offer the right balance for you. Don't get caught in the trap of blindly chasing one over the other. Instead, think long-term, think strategically, and use the Keystone Property Advisors strategic balance framework to make smarter, more informed property decisions that genuinely build your wealth.